Do you know how to assess if a company can go bankrupt? Or how much cash it has? Or what type of assets it holds? Today, we are going to be delving into the world of accounting, and in particular, take a closer look at something called the Statement of Financial Position, or commonly known as the balance sheet. The balance sheet is one of the financial statements that businesses use to evaluate their financial health, alongside the income statement and the cash flow statements. It provides a snapshot of a company's financial position at the specific point in time, showing what the company owns, what it has to give back, and the equity of its owners. Let's break it down a bit. The balance sheet, in fact, is divided into three main sections: assets, liabilities, and equity. Assets are things that the company owns that have a value. This can include physical items like buildings, equipment, and inventory, but also intangible items like patents, copyrights, and even cash at hand. Liabilities, on the other side, are things that the company owes. This could be money owed to suppliers, loans from banks, or even future expenses that the company expects to have, like pensions or warranties. Equity, also known as shareholder equity, is essentially how much the company is worth, obtained by taking all assets and subtracting all liabilities from it. In other words, if a company sold all its assets and paid off all its debt, whatever money is left over is equity. So why is the balance sheet so important? Well, it allows anyone looking at it to quickly understand the company's financial health. Is the company heavily in debt? Do they have assets that they can sell if they get into trouble? These are the questions that the balance sheet can help to answer. The key thing to remember here is the fundamental accounting equation: assets equal liability plus equity. This means that a company's assets are financed by its liabilities and equity. Said it in another way, liabilities and equity provide the cash, the resources that are used by the company to purchase the assets. So let's now have a walk through the balance sheet together, and let's start from the asset side. Assets are the resources owned by the company. They are divided into two main categories: current asset and non-current assets. Current assets are resources that can be converted into cash within a year. These include cash, marketable security, account receivable, and inventory. Non-current assets, on the other hand, are long-term investment and cannot be easily converted into cash. These include items like property, plant, equipment, goodwill, and patents. Next up, we have liabilities. Liabilities are financial obligations or debts owned by the company. Similar to assets, liabilities are also divided into current and non-current liabilities. Current liabilities are obligations that need to be paid within a year. This includes account payable, accrued expenses, and short-term loans. Non-current liabilities, on the other hand, are long-term obligations that are payable after 1 year. These include bonds payable, long-term loans, and lease obligations. The final section of the balance sheet brings us to the shareholder equity. This is the amount of money that would be returned to shareholder if all assets were liquidated and all the company's debt was paid off. Equity consists of share capital, share premium, retained earnings, and other reserves. Share capital is the book value of the shares that have been sold and are owned by the company shareholders. Share premium is the excess paid on top of the book value of the shares. Retained earnings represent the cumulative net earning or profit of the company that has been retained by the company since the inception. We hope this walkthrough gives you a clearer picture on how to read a balance sheet. However, this has to be read in conjunction also with the other financial statements. So if you want to learn more about accounting and become a better investor, then stay tuned for more financial tutorials.